saying cheap? It depends on the different...
It all depends on interest rates. What's cheap, right?
Mm-hmm.
Right? So in an interest rate environment of 4% is the 10-year Treasury yield right now, right? Then I would argue that 8 times EBIT is cheap. Okay? So it's a 25 yield versus a 12 yield. You see, you inverse the 8, you get 12%. You inverse the versus you get 12% on your money pre-tax versus 4% on the fixed income on the 10-year Treasury yield. An enterprise to EBIT of 8 is with this tax rate is a 12 PE. I'd rather own a 12 PE entity than a 25 PE entity, which is what the 10-year Treasury is. So you could argue that a 9 EBIT is what? It's a 9. It's like probably like a 14 or something like that, or 13. That's not expensive against the 10-year Treasury yield. And I said, you probably make money on it. It's just, I can't get that excited about it. And it's trading closer to its 52-week high, and it's not any cheaper than anything else I have in my portfolio right now.
What do you see are the typical mistakes that other investors make, or the mistakes that you tend to make? What are the...
When I go off the reservation, when I talk about the DRAM episode where had a strong balance sheet, it was obviously a cheap valuation, but they just burned cash. I'm probably making the same mistake right now. There's another I have a token hold position in something called Seahawk Drilling, which is a spin-off from Clyde. Book value is 44. They had $70 million in net cash. It's a bunch of shallow water drillers. It's a 1,500 share position. I just want to keep track of it. The enterprise value is probably like $200 million now. Its peak EBITDA, which was in 2008, it had $245 million in EBITDA. So it's trading at less than 1 times EBITDA or 2 times EBITDA. It's really cheap. But they're burning cash. There's no one drilling for gas in shallow waters in the Gulf of Mexico. And I don't own that many energy companies. I'm definitely the last guy to know anything in that business. So it's either going to go to 0 or it's going to go to 100 because it's really torqued energy. So, or it's really torqued to the gas price or the spot price of gas. So when they're burning cash, you have a limited amount of time, right? Your time's given up. I would say I'm not going to comment on the type of mistakes other money managers make per se, but I will say that we define our risk differently. I keep on repeating this, that we define our risk differently. I define again, half the money is mine in the fund. I care about whether I'm going to lose money or not. I don't care about whether I'm going to outperform anything. Well, actually, I only care if I'm going to outperform inflation. My job is to increase the purchasing power of my partners and myself over a period of time. That's it. That's all I do. Okay? And anything else is extra. And so I don't care about the stock price. I care about the value of those companies that I own. And that's what I focus on. If the stock price is down 40% and the value is the same, I don't care. I'll buy more. Or I hope that company has the balance sheet that I generally seek so they can buy more. And that's all I generally don't care about. But if the stock price is down 40%, there's probably something wrong with the company. If it goes down 40% one day, there's something wrong with the company. You've got to revisit all your assumptions again. Or something changed. Or the risk you took, it actually came to fruition. Because there's always something. There's always some risk that you just have to take because it's the business.
So usually when the stock prices go down 50%, fundamentals are going down the tubes also.
Yeah, but not by 50%. The earnings power probably goes down. They definitely missed the earnings. Okay, but the question is how much does the normalized earnings power go down? The market was down 37% in 2008. The GDP was only down 6. Okay, and I can understand where the marginal. If you lose 6% of your marginal revenue, then the marginal profits are probably down close to 50%. So the net income, because most companies are torqued. Your last dollar of revenue probably has like a very high incremental margin, probably 50% or something. But eventually the economy will come back, and that net income will come back. You would have to. Everyone was trying to stabilize the economy. I mean, they're giving away zero money now, but they were giving away zero money then. They're throwing $1 trillion surplus into the system. So everyone's trying to get the economy back to where it was in 2008. And, I don't think America was worth 27% less or 37% less in 2000. Between January 1st, 2008 and December 31st, 2008, the market lost 37%. The GDP was down 6%. I'm pretty sure the United States of America was not worth 37% less in the aggregate in that 12-month time. So you know, you just keep your focus on normalized earning power and make sure the company doesn't go bankrupt.
Do you try to time your purchase and wait for the fundamentals to improve?
It doesn't work. I can't do that. I'm sure some people can. It doesn't work for me. I can't do that. I mean, I'm invariably like buying all the way down, and I don't buy enough at its 52-week low, and then it shoots up, and then I'm spoiled. I said I know it's undervalued, but I could have bought it at 6. It's now 9. I don't want to buy it, and then it goes invariably up to 33 or something like that. So yeah, it's hard to do.
Right.
I mean, because you are going to get. I mean, I'm not going to lie to you. You know, I didn't. You know, 2008 in hindsight, hopefully was a great opportunity to upgrade the value of my portfolio. If I did my job, that's what hopefully happened, and we'll see in 2010, 2011. So far, it's played out in 2009's results. But I'm not going to say that there weren't some very anxious moments in that 4 or 5 month period. I mean, there was a time there, going back to when the reserve money market broke the buck. It could have been over very easily. You could have been, the ATMs could have closed up, literally. Okay, and the cash you had in your pocket was the cash you had to feed your family on until they figured out what was going on, because no one was trusting anyone. And you know, when you lose, I lost 27% that year. You think about it, but as long as it doesn't paralyze you, as long as you're saying, you know, in November 2009, you could have bought Google at $250. That's the low point of Google in this cycle. They had $60 in cash. So in other words, you were really buying at $190, right? This is November 2008. It's a great business. They take nickels for basically advertising, and it's a very good, effective way of advertising. It's the highest return on capital for advertisers. So you know it's good for their customers. And you knew that on a pro forma basis, and you can argue whether you should do pro forma or not, that's basically when they don't include the options, that's expenses, that on a cash pro forma basis, they were going to earn $29 in 2011. So you could have owned one of the best top 10 businesses in the world in November 2008 for an effective price of $190 that was going to earn $30 2 years later. Or, yeah, about 2 years later. That's a pretty good deal. Plus, they were going to collect another $20 in cash. So 190, your risk would go down to 170. 170 for $30. Same as it's the same as saying, well, if I were to pay you $30 $1 a year, are you going to pay me $6? I would take that bet all day long. Plus, Google's probably going to grow 10 to 15% continually in a normalized economy for the foreseeable future, for the next 2 or 3 years. So on one hand, you are anxious when there's a down drop in the economy. But how can you not get excited when you have bargains like that? It's very, I mean, in that sense, you know, you get anxious, but you also get very, very excited.
Well, if you have 100% of your portfolio committed to some existing positions, then you get it.
No, well, you got to upgrade it, because what you do is you take your losses, because you're going to have losses, and you say, well, would I rather own this crappy business at 6 times earnings, or Google at 8 times earnings, right? And you say, I'll bet on Google. This crappy business that's trading at 6 times earnings, that's cheaper on a 2010 basis and 2011 basis, but it doesn't have the same growth rate. So it's not as cheap on a 2012 basis or 2013 basis. And you say, you know, you just ask yourself, which business would I rather own for the next 4 or 5 years?
It's fully rational in the speaking, but when you have loss, people are very, very reluctant to cut losses. This is human psychology.
Right.
When you're down 40%, you know, your crappy business down 40%, it's very, very difficult to cut. You got to make up. What, if you're down 50%, you got to make 100% just to break even.
Well, that's why investing is not for everyone. I mean, what I described to you is simple math. You don't need more than 6th grade math to do what I do. You didn't certainly.